There must be a reason for that, right? So this one's going to be a little more involved. Make sure you spend some time with it. Yes?
Do we have an online test too? Or
Yes, there will be an online test.
And does that test start?
Nope, it'll get pushed back a week also.
It will, okay.
Correct.
And that extra view is for to do the...
It's just how the special journals work and a little review on the special journals. Okay?
Thank you.
Yes? No? False question.
I just wanted to know how many points were you paid for your mini product?
Oh, come ask me.
Okay.
All right? It's 100 points total. Let me do it from memory. The general journal was 23 points.
Yep.
The adjusting entries are 4. The closing entries are 4. The general ledger is 25. The worksheet is 20.
Yep, 5, and then 5,
The
5, 5.
five for each of the financial statements and 4 for the questions at the back. Ooh, not bad. I actually remembered. Okay, other questions? Good to go? Welcome to Chapter 9. Chapter 9, we're going to cover the remaining special journal, which is cash receipts. Good? We'll deal with this. Okay. We're going to... Cash receipts and the things that go in cash receipts depends on what kind of business you're in. So think about an example here. The example we were doing a moment ago was a wholesale business, right? If you're a wholesaler and somebody comes in and pays cash, it could happen. Do you have a need for the sales tax column? Not at all. So in that instance, the cash receipts journal would look a little different. Okay? Some businesses take in a lot of cash. Some take in a lot of cash and checks. Some take in a lot of credit cards, right? Some businesses, a lot of businesses that give their customers credit terms, right? If I extend business credit to you, I give you 30 days to pay, you're going to mail me a check, right? Somebody's going to go out, get them, can't talk all of a sudden, get the mail out of the post box, or the guy's going to come in and put it on the counter. You're going to go through it and find all the checks, open it up, and you're going to apply cash in the cash receipts journal. Okay? If you are a retail business and you don't give customers terms, you're not going to have that function. Good? Look, we spent the first half of class with you guys very much engaged, talkative, interacting. Okay? All of a sudden, we're all real quiet.
We're so interested.
Nod yes, no, or I don't know. Okay? All right. All right, cash receipts journal. This is the biggest and most involved one of the 4 special journals. Again, little format. What do they always start with? Date. Description. Here's what's going on. Here's that posting reference. We've seen this a lot. Accounts receivable credit. Somebody mails in a check to pay on accounts receivable. The accounts receivable balance goes down, which is a credit, right? Sales tax payable credit. Sales credit. You know, if we make a sale for cash, you need these 2 accounts. Other, we got this great big other. And then we've got the debit to cash. Other accounts credit. The only column that we have here that's a debit is cash, right? Cash receipts, we get cash, it's a debit. Lots of things can go in the other column. One example we've already seen is the owner makes an additional investment in the company. We can put that here. You put what account is affected, owner's capital, and the amount. The posting reference here is treated just like the the post reference on, say, the purchases journal where we're posting to the accounts payable subsidiary cards, right, the subsidiary ledger. So when we post, let's say the account name, owner's capital, let's say the account number's 490. When we post this amount to the owner's capital account, we put in the post reference of 490 there. Okay, because think about it, I can't total these down and they don't all post to one account. You're going to have multiple accounts to post to from this column. Good? Okay, I got one nod, we're headed somewhere. Okay, debits to cash, credits to everything else. I can't read what it says at the top, can you?
End of the month, the total
Oh,
asset.
exactly. Same as all the others, we're going to total them up and we're going to post it, one transaction, to the general ledger. Good? All of our debits and credits must be in balance when we total this up, correct?
Yes.
Okay. Cash sales and sales taxes. I love how the camera seems to move every class. Every week it's in a different place. All right. Let's just do one here. Here we've got a sale. What do we know about this sale? Somebody help me out here. What?
Credit sale to a client.
Well, what's the first thing we know? We got cash because it's going in the cash receipts journal. Yes? So we've got Roy Anderson as a customer of ours, and we got cash from him. We got a debit for $432 and a credit to accounts receivable. So he's making a payment on his account, right? Good. Cash sales on the 8th. Cash sales. This sounds like a total of 8 sales from my register, correct? Because we're a retail store. I got $4,860 in cash. And notice, these are in the wrong column. They need to come over here. I love it when they make it easy for us, right? Okay, sales tax payable. There was $360 in sales tax on this. And the sale was for $4,500. It would go in the sales credit column. Good? Okay.
So I can't quite read from here. The cash debit column is not in running total?
No.
Okay.
So notice this equals these two. Your debits equal your credits straight across.
Okay.
Okay? And if you really want to look, feel free to come up and take a quick look. Okay. Moving on. Okay. Here you go. I love this. People make mistakes. This is a header on a slide? Hang on a second. We all knew this. Is this a surprise to anybody? No. Okay. Now we've all done this. You walk into a retail store, you buy something, and they give you the wrong change, right? Do you tell them if they gave you the wrong change? Sometimes yes, sometimes no is what I'm hearing here, right? Okay. So they give you the wrong amount, either too much or too little. They make a mistake. You don't catch it. You take the wad of cash they hand you, you stick it in your pocket, and you leave. Okay? If you're honest and you do, they don't hand you just a wad of cash. They count it out for you. Usually they'll catch it if they do that. And you figure it out then. Or you tell them. So the guy can't count change that's running the register. At the end of the day, the amount of money left in the register is off from what it's supposed to be. Right? How do we account for that? What? Well, but we have to account for it somehow. Because all of our debits have to equal our credits. So if there's not enough money in there, we've got a loss. And if there's too much money in there, we've got a bit of a gain going on. Okay? So how do we record something like that? Let's look at this one here. I'm going to record today's sales. On the 15th, we had cash sales. The sales were for $4,800. The sales tax that went with that was $384. We actually only had $5,166 in the drawer. Does it equal at that point? No. We're missing $18, right? So notice, other accounts credit, we're actually over $18. There's an extra $18 in the drawer here. But my debit equals my credits in this case. Yes? If the drawer was short, we'd have to put this in brackets and show it as a minus, right? Because a minus credit is a debit, then it would be an expense. Everybody follow me? Okay. Before I leave this slide, I want to cover a couple other little things. So the first two we've already done, bless you. The third transaction on the 11th, Vicki Bowman. Here we go. Accounts receivable credit, cash debit. What did she do? She made a payment. She either mailed us a check or she came in and gave us cash. The next one, on the 12th, investment. M. Amos Capital, credit for $15,000, debit cash $15,000. What happened? The owner put more money in the business. Good? Everybody see how that one happened? And on the 13th, we had another payment from a customer. Good? Okay. Questions before I move on? Yes, sir.
I looked at the cash sales one on the 8th.
On the 8th, okay. Here we go. These are in the right column at least. On the 8th, we had cash sales. We sold $3,040 worth of stuff. There was $212.80 in sales tax that went along with that. And we collected $4,860 from our customers.
You mean the first two don't total up?
They don't add up? No, they don't. Hey, however, it's better than when they were in the wrong columns, right? There's some improvement here, but not enough. I'm still going to mark it wrong and give this student a lower grade. This student wrote the book, for crying out loud.
And then there was no sales tax, obviously, on Barbara Co's purchase.
Well, hang on a second. Barbara doesn't have a purchase. She's just making a payment. So the sales tax was included in here when it was a purchase originally, or when we made the sale to her. Okay? So yes, the math should work here. We would have to get this correct, or there would be a over and short on this day to make it balance. Okay? And if my employee comes in and he's that short, we're going to have a little meeting in the office and back, because, right? Old school Vegas style, right? Questions other than the obvious gaffe in the slide? Okay. Okay. What they're telling you here is if this is indeed a debit, because it's marked as a credit up above, the header's credit, to circle it. Okay, yeah. Okay. We can do that, can't we? All right. Cash discounts. If it's a wholesale operation, we don't have what anymore? Sales tax. But we may give discounts. And remember, we saw in our chart of accounts that we track our discounts now. So, there's no example? Bummer. Okay, I can make an example. What you do in that case is you can put a column in here for discount. Right? So if I don't need the sales tax column anymore, I can change the name of it and use it for something else. So these aren't set in stone. You can change your special journals to make them work for what you need. Good? Okay. All right. Promissory note. Have we talked about notes payable and notes receivable already?
No.
I lose track.
No.
Okay. Sometimes you'll have a customer come in and they have terms. They'll have 30-day terms. So you let them sign for accounts receivable, and in 30 days they don't pay you. We talked about that, right, under calculating bad debt? Yeah. Well, this person came in and said, hey, look, I don't have the money now, but I'm going to have it soon. How about, you give me longer time to pay? Well, in exchange, we had them sign a promissory note. I promise to pay you. We're going to charge them interest. at 9%. And we're going to document it because it makes it easier to sue them and go collect the money because they've acknowledged that they owe the debt in writing. That's what a promissory note is. Okay? If you go out and you buy a house, a car, anything where you have to make payments on it, you're signing a promissory note to someone else. This person signed one to us. Clear as mud? Yes?
When would you do a promissory note? Is there like a cutoff, 6 months is when you start doing that, or is it dependent upon the business, or what it is, or
It depends on your level of
trust and trust?
risk tolerance. Because if I get this in writing that they owe me the debt, it's easier to collect on.
Right. But you wouldn't do a promissory note for like 90 days?
I might, if it's somebody that I'm really worried about, because it improves your rights if he goes into bankruptcy. If it's a typical customer that I wasn't really worried about, maybe not. Okay?
Dollar amount.
Yeah, depends on the dollar amount too, yeah. Okay, so there's an example of it. Promissory note, it has to say, I promise to pay on a certain date at a certain interest rate. They've got to sign it, all that good stuff. Okay. All they're telling us is you move it out of accounts receivable and you move it into its own general ledger account, notes receivable. Right, so you'd get an entry for notes receivable, and you would reduce the accounts receivable balance by the $800. Okay, so we separate it from, these are doing 30 days, this one's due longer, so we separate them. Good? Okay, yes? All right. Oh, look. Right when I think they're going to cheat me out of the slide, they give it to me. Does anyone know how to calculate interest on a note receivable? What? Computer was the right answer. Go ahead. You have a better answer, though.
Figured out per year for the amount of the life.
I'm going to go back over there. The formula is interest equals principal times rate times time. What? It's actually real simple. Okay? We want to know interest. The principal we know. No, interest in dollars. The principal is how much? It's the $800. We know that. Okay? The rate is the 9%. We're charging 9%. Now, interest rate is always stated in an annual amount. So if they borrow the money for the whole year, they owe me 9%. But they're not borrowing it for the full year. How long are they borrowing the money for? 6 months, right? Now I want to make this simple. Since we're calculating it for months, we put the number of months out of a whole year. A whole year is 12, right? So if it's only for 2 months, it's 2 divided by 12. If it's 6 months, it's 6 divided by 12. If it's 9, it's 9 divided by 12. If it's a whole year, it's 12 divided by 12, so it's just 1, right? Simple. So that formula works in any scenario as opposed to what they just did. So 800 times 9% times 6 divided by 12 is how much? They're going to tell us. Let's just cheat. $36. So the interest amount on this note is $36.
They're doing 4.5%.
Hang on a second. Let's do the math. What's 800 times 9%? $72 times, what's 6 over 12? It's the same as 1 over 2, right? What's half of 72? 36. My math works. They're teaching you this trick, though, that you just go 6-month period is divide by 2, which is harder to figure out. What if I gave you 4 months? What would you divide by? If you use this, you just go 4 divided by 12, it works. This is, I think, an easier formula. If you like theirs, use it. Yes.
What if you're calculating interest on the unpaid balance?
Yeah, compound.
Or if it's compounded yearly.
Yeah, if it's compounded monthly or daily. Crystal, what do you do if it's compounded monthly or daily?
What's the question?
If you're calculating interest compounded monthly or daily, what do we do in Accounting 6? We use a computer. We use Excel and we calculate it that way.
So much easier than doing it on paper.
It's the same thing, but you're modifying the time and you're doing lots of calculations. So instead of doing one calculation, you would do 6 different calculations, but it'd be 800 times 9% times 1 over 12. And you're rolling along that way. If you want to do it, come after class. I'll show you how to do it. We'll have some fun. Okay? For this class, this is as hard as I'm going to make this. Good? Okay.
That can be on the test.
Yes. Here it is. Here it is on the test. Promise. Okay? So the total amount owed at the end is $836. And in your example, you would take that and you would compound it, so your principal would become $836, and you keep going. All right? Daniel? Good? Okay. Oh, here we go. So we've got more stuff going on here. This is our cash receipts journal. We've seen this before. Got more things going on. Look at this one here. On the 17th, we got a cash refund for what? We went back to Staples and we took something back, right? And they gave us cash. And the employee brought the cash back, fortunately. Here's another cash sales. That was $2,700 in sales, $216 in sales tax. It was short $16. Good. Oh, it's over $16. I apologize. We have miscellaneous income, right? Good catch. Thank you. Here's the note we were just talking about. So collection of the note. Notice all this happens in the other accounts column. Note receivable gets credited for the $800. Interest income gets credited for the $36. Cash gets debited for $836. Now the only tricky thing here is, notice that there's no amount on this line right here. So it's these 2 transactions make up this one entry right here, because they needed 2 lines in the other column. Good? When you do the mini project, you're going to need to do this when we calculate payroll. Just so you know. So I wanted to show you that it's okay to do this, because you needed more than one other column. Yes?
I just have a question really quick, because I don't know how this works, but say you have that whatever that note's called.
Note receivable.
Okay,
Promissory note, yes.
And that person doesn't pay it within that time frame, and they come back to you and they say, oh, I can, here's a half payment or whatever, and then can you extend it out? Do you make another one, or do you just say, no, sorry, piss off?
You could tell them, no, I'm going to sue you, pay me now. Or you could cut an agreement where sign a new note for half of it, but pay me the half.
And then you would do the whole interest
Yeah.
based off.
So you owe me $836. Pay me $436. We'll sign a new note for $400, and we'll go on.
You wouldn't go back in and calculate the interest out to a different rate?
To a different time period? No,
Yeah.
because it would become a new note.
Okay,
Because this one says you'll pay me on X date.
okay,
Okay?
yeah.
Okay. Other questions? Yes.
Yeah, that's probably a dumb one. You don't distinguish here between like writing cash and checks, and
On the cash receipts journal, you do not.
you do not. Would it be useful to, like instead of just one cash debit column, have two? Just so you can
I'm sure you could do
track
that.
Cash in that way.
Yeah. You could track cash. You could track checks. You could track credit cards. I mean, if you really wanted to.
Are there better ways to do that? Are you going to go into petty cash?
We'll talk about that a little bit, yeah. It's in the book. It's not a huge ordeal, so we'll cover it pretty briefly. Okay. Yes, ma'am.
Do you record all promissory note payments at the end of the month, or
That was the day it was due.
Okay,
That's all. So if it was due on the 10th, it'd be up here.
okay. It's not a separate.
No. So it's kind of misleading that they left 2 lines. Yeah. Yes, ma'am? Yes?
So, the promissory note, I think it's really stupid. Why wouldn't you just have interest on your accounts receivable?
Well, think of this in terms of the concept as opposed to what we're doing. What if this guy promised to pay me and it was a big chunk of money and it was going to be 2 years? Okay? So I really don't want that to become accounts receivable, because when we show accounts receivable on the balance sheet, we list it fairly high, implying that it will be turned into cash quickly. But if it's 2 years, it won't. So by definition, accounts receivable is that trade receivable that turns over fairly quickly, and a note being more long-term needs to go and be presented in a separate place. Okay? Yes?
So this person has 6 months to pay off the $800. The interest would be $36.
Correct.
Within the 6 months.
Correct.
At the end of 6 months.
Right.
They pay it off in 2 months, then...
We would change the calculation over here, and we would replace the 6 with the 2
Right.
and calculate a new number.
But the original plan was for them to do it in 6 months, so you document it in the receipts journal for 6 months.
We don't include the interest until we actually receive it.
Oh, okay.
So I don't need to do this calculation until I know the date that he made the payment. Okay? Other questions?
Just to follow up kind of on what she said, if that had been split, if there were a 6-month term and then the person paid it off in 2 months, each time you collected, there would be an entry, and then so half the interest would
Great.
be shown. Okay.
Correct, yes. So he'd owe a smaller amount for the second payment, so there'd be less interest owed. Okay? Because it's dependent upon how much is owed, the principal. Good? Yes?
Can you just have a note on your promissory note that says, like, even if paid ahead of time, interest is still as recorded? Because it's like you're still taking the time and effort.
You
to write
don't
all this
record
down.
it though until he makes the
Oh,
payment.
I know, but like, you went through all that paperwork and now they're gonna pay it off early and you're like, well, all that time that I worked with you was wasted. You should still pay me that $36.
If you borrow money from a bank,
You want to get through.
yeah, if you set up some sort of a note with a bank, they'll have in the contract that you're going to pay for the fees and costs of drawing up all the documents.
Yeah.
So you're paying them for it anyway.
Yeah.
So, or if you're a good customer, they won't charge you. That's a negotiable item. Never just accept it when they tell you, we're going to charge you for this. Right? Always negotiate that one. Good?
Does that person have a ledger, a subsidiary ledger? Is that-
No, because it's not an accounts receivable anymore. So it comes out of the subsidiary ledger for accounts receivable, and it only exists in a note. If you have lots of notes, you may keep a ledger of your notes. You could create one for that. But hopefully you don't have this problem where you're converting a lot of them to notes.
It just goes in as an AR.
Nope, it goes into notes receivable. It does not go into AR. It comes out of AR. Okay? It comes out of accounts receivable and goes into notes receivable. Okay? Yes?
Do you have to start it with accounts receivable, or if you just know they're going to pay, you just do work and you know it's going to be...
This guy's a buddy of mine. You know, he owns a business down the street. He wants to borrow some money. I have him sign a note.
Right,
I didn't sell him anything.
exactly.
And bang, we can create a note. Doesn't have to be accounts receivable.
Bought something from you, but you knew they weren't going to
Yeah.
pay it off.
So
until
if indeed you know that I'm going to sell you something and I'm going to get $200 in cash, $800 notes receivable, and sales of $1,000. Okay? There you go. And I'm going to give you 6 months to pay. Good? Or a year to pay, or whatever. Okay?
So anytime like an account that's on credit goes over 30 days, it gets
No, not necessarily. This is when you negotiate an agreement with the customer that, hey, I'm going to give you more time to pay this. Okay? Typically, they don't become notes. They don't pay you, they don't pay you, they don't have any money. It becomes a struggle, it becomes a bad debt. This is more infrequent. Okay?
Is the interest only documented upon receipt?
Of payment. Okay? When we get to chapter 12 and we start talking about adjustments, you can accrue this monthly in the worksheet. For today, don't worry about that. Okay? A couple of weeks we'll do that. Good? Yes, no, maybe? What? Somebody want me to go?
Yes, by the end of the month, we are having the totals of that, but we don't have.
We're going to get there next. We haven't done that yet. Okay? Okay. So the end of the month comes. And what we do is we take each of the columns, accounts receivable, we total it. Sales tax payable, total it. Sales, total it. Other, total it. Cash debit, total that. We prove that it's in balance, that we did our math right, and that we posted everything right. Everybody good so far? Just like all the other journals, you can post this and put your posting reference. Accounts receivable goes to account 111. Sales tax payable is 231. Sales is 401. Cash is 101. Other is X. What's that? Remember that we have all kinds of things going on in here. That's why we needed an other. So you can't take this total and post it to one account. They go to different accounts. So I've got $15,000 going to owner's capital. I've got cash over and short. I've got supplies, cash over and short again, notes receivable, and interest income. So that's when this posting reference column comes into play. And we're going to post each of these individually and write in the posting reference, like they did here. Notes receivable, account 109. Interest income, account 491. And we need cash over short, supplies, and capital. Okay? Everybody good with the concept? Everybody good with the concept? Thank you.
I have a question.
Yes.
Like you said, instead of 6 months, this guy came in here and paid in 2 months. That quantity is not the same. We have registered.
No, but it'll get recorded for the right amount. You don't calculate it until he makes the payment, and then you just record it. So it'll be recorded for the correct amount. Okay?
And that total would be different.
Yes, it would. So if he paid in 2 months instead of 6, we wouldn't be recording it in January. We would have been recording it last year sometime. And say he only owed $12 in interest, it would have been $800.12, and we'd total it up, and it'd still be in balance.
Oh, I see.
Okay? All right.
Thank you.
Yes?
Earlier, when people read circles up and determine that it's all in balance, where do we determine that? Because I don't, unless I'm really tired, I don't see anything.
They didn't circle this one right here.
Right? But what is balancing out right there?
Okay.
Is there credits?
Credit, 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 debit. Your debits and your credits are in balance.
So all those credits are, okay.
Yes. Okay.
Thanks.
So these get posted to the accounts like we talked about, and then the 15909 gets posted to all the individual accounts there. Okay? The other thing, we have posting reference column over here. So as we receive cash from a customer, notice it's all these in this column here for accounts receivable. These have to get posted to their customer accounts receivable subsidiary ledger. And when we do that, we put the posting reference here, just like we did before. Here's an example of one. This is Roy Anderson again, our buddy from Texas. He had a balance of $432. We sold him more look, sales journal 1, sold him another $432. On the 7th, he made a payment, cash receipts journal of $432. And then we sold him some more stuff of $267. His balance is $699.50. So beginning balance, increase, decrease, balance, increase, balance. But once we post this cash receipt, we'd come back over here and we'd put the check mark here in the posting reference. Good? And just like all the other ledgers, or special journals, sorry, you would do these every day at the close of the day. Okay? Good? Great. Okay. Cash payments journal. We love the cash payments journal. The cash payments journal is basically a big miscellaneous column. Too much stuff. Go ahead. Okay, so following the format at the top, date, check number in the little column, description, posting reference, accounts payable debit, for when we make a payment on accounts payable, other, posting reference to other and amount, purchases discount credit, cash credit. Not a lot of columns, right? Most of your activity happens in the other columns.
This is like a check balance meeting.
This is your check register.
Check register.
Okay? So, debits and credits, again, you want all of these are debits, and you want them to equal your purchases discount and your cash credit in these two columns. Cool? So here's that example that they just threw up there. January 3rd, we made check number 111 to pay the January rent. The other column we put in rent expense, right? Because there's no column for rent expense by itself. $1,500 debit to the expense, cash credit $1,500. That would get posted to rent expense account 634. Here it is. Here's a general ledger account 634, rent expense. January 3rd, cash payments journal, page 1, $1,500. Calculate the new balance. Good? So everything you put in the other column gets posted there. Okay? What is this? Who wanted petty cash? All right. What is petty cash? Pain in the butt. That is the A answer.
I think Bob's focused on that all proportion.
Yeah. Well, and there's a reason why. No matter what business you're in, something's going to happen where you need to have a little cash sitting there so that you can deal with, having to send somebody to Staples because we're out of batteries for the remote control, or we need a dry erase marker for the meeting in 10 minutes, okay? Or UPS shows up with a COD delivery. So you have a petty cash fund that's always kept by one person. You assign it to one person. That way if there's a mistake, you know who to go after, right? Failure to assign it to one person is a mistake. So basically you fill out a request for petty cash. No, you take the receipt, you go over to the person with petty cash and say, here, I need $16.25. Okay? They put the tag in the envelope or in the box, and they give you $16.25. So the basic concept is, let's make it simple. Our petty cash fund is $100. At all times, the total of all the cash and all the receipts in the box equals $100, right? When we end up with more receipts than cash, we put them all together and we fill out a little form and we send it to accounts payable, and they'll send us back a check so that we can go cash it and get more cash to put in the box. That's petty cash. Okay? If they don't bring you receipts, you don't give them any further petty cash.
That's what I did.
Yeah, you are done. Okay, by the way, sign here saying that you did take this original cash, so I don't get blamed. Yeah. Okay? The book talks about vouchers and all kinds of stuff. Just bring me the receipt. Okay? I kind of covered this. Any questions on taking the receipts and going and getting a check in exchange? Okay. The book will tell you this, and it's true. A lot of companies will, when they replace the petty cash, you turn in all the receipts and accounts payable gives you a check, they'll make the check out to cash. That's a bad idea. Why? Anybody can cash it. If I lose it on the way to the bank, or if I drop it. What?
What would you write down instead?
Well, if you're the person responsible for accounts, for petty cash, have them make it out to you. That's what you should do. Okay? That's a little twist. We talked about control procedures. These are in the book. You don't want to have too much cash in the fund, right? If you figure you need $300 a month, keep $300. Don't put $600 in the fund. Why? It's temptation. Cash is the first thing people are going to steal. So the more there is there, the greater risk you have and the more likelihood you're going to have a problem. All right? Have one person do it. Keep it locked up somewhere. All the fun stuff. These are in the book. Have fun with them. Oh, here we go. They're talking about cash receipt stuff now. I love this. When you're dealing with cash, even if it's checks, right? Because there have been cases where an employee who gets the mail and makes the bank deposit and reconciles the bank account. You do it all, right? Yes. Okay. So you open the mail and you endorse the checks to yourself, and then you go to the bank and you cash them. People do this stuff. It's stupid. You're going to get caught, by the way, if you do that. But people do these things. So separate the duties. Have one person get the mail, open the mail, give the checks to somebody else who prepares the deposit, okay, and have a different person reconcile the bank account so that not one person can hide all the fact that there's somebody stealing the checks. Got it? Have a fourth person apply it against the accounts receivable subsidiary ledgers. The more people involved, the less chance you have of being thieved upon. Is that proper English? Maybe. I don't care. It's after 8. I don't care. Okay? Deposit cash every day. Don't leave a bunch of cash sitting around the office, because what happens? It gets legs and it disappears. Okay. Oh, make all payments by check if possible. Okay? Don't keep a lot of cash around, right? It's pretty obvious. And this is kind of old school. A lot of companies now will pay their accounts payable stuff via, well, ACH payment. Yeah, online from the bank. No paperwork at all.
They usually give you a discount when you do that.
Yeah, you better negotiate one. So, this talks almost exclusively about checks, but that's kind of a fading, old school way to do it. But if you're dealing with checks, it talks about have numbered checks in sequence, so if somebody steals a bunch of them, if they're missing. Have one person prepare the checks, have another person be the authorized signer, who's got to match the invoice with the check, so that the person who's making the checks isn't paying her Aunt Sue, sort of thing. Have somebody who approves any new vendors, that this is okay for them to be a vendor and we can start writing them checks. That way the guys in the mailroom don't start creating bogus vendors and sending themselves checks, right? All these things happen. All this stuff happens. Okay? If I'm in the mailroom and I can make up fake invoices and submit them and approve vendors, you're just, you're writing checks and mailing them to my P.O. box in Salinas, right? I like it. So, one person sign them, lock the checks up, and have a separate person reconcile a bank account. Good? Okay. Banking. This is where you come up and do this for us.
I'm following along.
Okay. Correct me when I screw this up. The biggest thing about this is Everybody knows what a check is, right? This is a negotiable instrument, if we had that conversation. Okay, pay to the order of, on a date for an amount. Okay, got to sign it. If they endorse the back of it, then they can give it to somebody else, theoretically, right? You have to sign the back of a check when you cash it at the bank, right? Everybody's had to go down and, yeah, okay. There are different ways to sign the back of it, i.e. negotiate. This is very old school if you're using a computer, and I guarantee you are. You're not going to ever see this part of the check. Okay, but it's in the book if you want to see how it used to be done when coal was new. Okay, when you sign the back of the check, most of us just go down and sign your name, right? If you do that, you're in essence converting it to pay to the order of cash, and anybody who has it could then deposit it, right, or cash it. If you write on there, pay to the order of the bank, and your account name and number, you limit who can go deposit the check, right? So most companies have a stamp, and they stamp this on the back so nobody can deposit that check in their own account. Trust me, if you just signed the Style Shop on the back and let it go, and you sent somebody down to the bank with 400 grand worth of checks in an envelope, they might deposit it in their own account and decide they're going to, buy a few things for Christmas, right? It's happened. That's why this stuff comes up. So the big restrictive endorsement, this is the best you can do. Pay to the order of the bank for deposit only to your account with the account number. This is what every business's stamp looks like, that they stamp the back of their checks. No one else can do anything with that account. It can only go into your account. Good? Questions? Answers? Oh. Okay. You know what we're going to do? Yeah. We're going to go into doing a bank reconciliation. And we're going to come back and do Chapter 8 and 9 homework anyway, right? I'm going to save the bank reconciliation. Oh, because I think you guys have worked hard tonight. So you can turn that off. And